Blog Talk Radio.
Good evening. Welcome to the View Up Here. I am your host, Canadian Glenn, and it is June 20th, 2018. Tonight's a show I've been looking forward to airing. Who's not afraid of facts on Kinder Morgan with guest Robyn Allan. Facts, Kinder Morgan, Trans Mountain expansion, very rarely shall the three intersect. And that's by design, extensive design. Can't escape Kinder Morgan and Trans Mountain in the news, but some factors like climate just fade from the narrative because they're inconvenient facts for the proponents of TMX. Others, such as a multi-year failure of Kinder Morgan to finance the project, that's all moot now with the federal bailout. Corruption and incompetence of the National Energy Board continues to be unearthed. But when the Trudeau government breaks the promise of a new process, what does it matter? Fuel prices will increase due to tolls on the expansion approved by the National Energy Board. Yet you hear stories about how gas will be cheaper in the Lower Mainland. There are no untapped markets. U.S. refineries are the best price out there for this heavy, high-sulfur, inferior product. And that's the way it's been planned all along. But no TIDEWATER shall set you free. Let the good times roll. Stranded assets are two words you'll be hearing more and more. And what about everybody's favorite part of NAFTA? Chapter 11, ISDS. Well, who's afraid of these facts? The Trudeau government, the Notley government, Kinder Morgan, corporate media, and lobby groups such as CAP. Who is not afraid of these facts? Robyn Allan. Robyn Allan is an independent economist and has held many executive positions in the public and private sectors. Robyn is a past economic and financial advisor to the Barrett Commission, expert witness on economic and insurance issues related to the Northern Gateway project, and expert intervener on economics, risk, and commercial need at the Trans Mountain expansion hearings, until she resigned over what she termed fundamental flaws in the process. An author and investigator, her work has been carried by the Globe and Mail, the TIE, National Observer, Financial Post, Vancouver Sun, many others. But she's been involved in bringing truth about Kinder Morgan from the very start. Over 4 years for Robyn. And we're happy to welcome her for some facts. Now, Robyn is a busy lady. So what I'm going to do is I'm going to provide the background for the questions I'm going to ask her in the interview. The interview is an hour 20. So you got about a little more than 30 with me to set it up. It's worth it, believe me. Let's start at the start, just for a Cliff Notes version. Now, just about everything I'm going to quote here, unless I say otherwise, this has all been written by Robyn Allan. Kinder Morgan began as a publicly traded Enron tax shelter in 1992 called Enron Liquids Pipeline Limited Partnership. Now, publicly traded limited partnerships in the U.S. are called Master Limited Partnerships, MLPs. Ownership shares are units. MLPs are treated as a partnership for tax purposes, and none of the income is subject to federal income tax. They combine the tax advantages of a partnership with the liquidity benefits of publicly traded stocks. Now, the Enron MLP held the energy giant's liquid pipeline assets, as well as some gas processing and coal transfer and storage facilities. The general partner, Enron Liquids Pipeline Company, was the operator. In February 1997, Richard Kinder and William Morgan acquired Enron Liquids Pipeline LP from Enron Corporation by buying the wholly owned general partner, Enron Liquids Pipeline Company. Acquiring the MLP and the general partner was hardly an arm's length deal. Kinder continued to receive a paycheck from Enron until the day after he took over the company. Morgan, also a former employee of Enron, had been on the board of the general partner since 1994. With the assets from Enron acquired to establish Kinder Morgan Energy Partners, LP, further known as KMP, people in BC are familiar with that, Kinder and Morgan created their own board of directors and executive team. The roster was heavily weighted with Enron insiders. Out of the 9 original directors and officers, 6 were Enron employees, and the 7th member of the team, Michael Morgan, was William Morgan's son. The treasurer and secretary of Kinder Morgan's company was an independent tax and accounting consultant, underscoring the entity's continued emphasis on tax planning. Within months of acquiring the corporate entities, KMP filed a prospectus with the U.S. Securities and Exchange Commission to sell 3 million units of the MLP to the public. Kinder Morgan's 1997 prospectus promoted the tax-related properties available to maximize unit holder returns over what they would be if they were limited partnerships were treated as a corporation. The prospectus explained that the U.S. tax code requires publicly traded partnerships to be taxed as corporations. However, a natural resource exception exists. If the partnership earns 90% or more of its income from the exploration, development, mining, or transportation of any mineral or natural resource, including oil. So that exclusion means KMP does not face corporate tax at the partnership level. This increases cash flow available for distribution to unit holders, including major unit holders like Kinder and the general partner, KMI, again with Kinder as a major beneficiary. The special tax treatment, a U.S. government subsidy, is what enabled Kinder Morgan to grow into the 3rd largest energy company in North America. In August 2014, Kinder announced that his energy empire would undergo a makeover. The restructuring will see KMI purchase the other 3 publicly traded entities and consolidating them. The reorganization, by its leaders' own estimates, reduced Kinder Morgan's taxes payable by more than $20 billion over 14 years. So effectively, KMI gets to work the intricacies of the accounting system. It buys assets from its subsidiaries at a premium price and then depreciate these assets as if they were brand new. That deal creates $1.4 billion in tax savings each year for at least 2 decades. Now, how did the market react to this? Kind of thought of a good word there, but I can't use that one. How did the market react to this reshuffling of Kinder Morgan's corporate structure? Well, the day after the deal, Rich Kinder pocketed an extra $800 million. Now, these MLPs do not exist in Canada. Now, they have cousins, Canadian Income Trusts, but they lost their special corporate tax privileges in 2006, courtesy of Jim Flaherty. Now, Flaherty himself, at the time, said that he was worried about so many corporations changing to a trust structure. He called the behavior a growing trend to corporate tax avoidance. Jim Flaherty said it's not right and it's not fair. But Kinder Morgan has shown it knows how to acquire a Canadian firm and absorb it into its U.S. operations, converting it effectively into an MLP. That's the story of Terrazin, a BC corporation that held natural gas and oil pipeline assets, including the Trans Mountain Pipeline. Kinder Morgan purchased Terrazin flat out in 2005, approved by Investment Canada. They delisted Terrazin from the Toronto Stock Exchange and absorbed it fully. After the purchase of Terrazin, KMI engaged in a number of intercompany transfers involving many sophisticated entities, including an unlimited liability corporation registered in Nova Scotia. The Trans Mountain Pipeline assets were eventually sold to KMP. And you'll hear Robyn use this, they dropped them down. They dropped them down into the U.S., the ownership. So then they were basically tax-free. And Robyn says right here, this is how Trans Mountain came to be under KMP's indirect full ownership control by 2007. The Terrazin share purchase and related intercompany paperwork effectively turned Trans Mountain into a U.S.-based MLP. However, there is a paucity of publicly available financial information related to Trans Mountain because Kinder Morgan reports on its Canadian operations to the U.S. Security and Exchange Commission on a consolidated basis as part of KMP. That means there are no separate financial statements filed related to its Canadian activities, and this makes accurate evaluation of the company's Canadian operations difficult. But this we do know. Kinder Morgan Canada President Ian Anderson told analysts in Houston in January of 2014 that the Trans Mountain system received a cash tax refund of $4.2 million in 2013. And this was while generating $167 million in distributable cash flow. When Robyn was on the board as an intervener, she asked Kinder Morgan to explain the discrepancy between its filing with the NEB, what it tells the Canadian public about its contributions to fiscal revenues, and what it tells U.S. investors and analysts. The questions were filed in an information request as part of Robyn's right as a qualified intervener in the hearing. Kinder Morgan refused to answer. Robyn then asked the NEB itself to compel answers. Siding with Kinder Morgan, the board denied the request. Robyn believes Canadians are owed an explanation why this U.S. multinational pays so little in Canadian corporate income taxes related to Trans Mountain. The NEB seems content to buy Kinder Morgan's story that it will pay a tax rate of 25% on its net income and that its expanded operation will lead to about $100 million a year in federal and provincial corporate income tax revenue. Indeed, in arguing for the Trans Mountain expansion, Kinder Morgan presents itself to Canadians as a significant tax contributor. Yet Kinder Morgan now repatriates an average of $172 million per year from the Trans Mountain system for distribution to its U.S.-based owners, but faces an average cash tax obligation of only $1.5 million. Another issue I'll go a little more into after this is the tolls. The tolls are what the oil producers have to pay Kinder Morgan to get it to Burnaby or to Washington State. The NEB, just like the CRTC, decides what you pay. Today it costs about $2.75 to ship a barrel of oil to Chevron's Burnaby refinery on the existing Trans Mountain. If the expansion goes through, the price to ship that same barrel to Burnaby will be more than $5. Now, since 90% of the gasoline supplied to the interior and south coast of BC comes via Trans Mountain as either crude or refined products, these higher transportation costs are passed on to the consumer. Every time a BC resident fills up, it lines Rich Kinder's pockets. If the Trans Mountain expansion is approved, that amount increases substantially. Now, this is from someone who was, at one time, an intervener on the hearings. There's a background on what Kinder Morgan is. Now, around the time that the federal government gave approval, at which point in time Robyn Allan had already left as an intervener, September 7, 2016, there was a Pacific Caucus town hall at Simon Fraser University, and in attendance were Liberal MPs Terry Beach from Burnaby North Seymour, Joyce Murray from Vancouver Quadra, and Joe Pescisolito from Stevenston, Richmond East. Now, Robyn was asked to give a presentation at that town hall. I will read now from Robyn's statement that night. Prime Minister Trudeau recognized this time last year that the NEB could not be trusted. He said the board had torqued reviews, making it easy to recommend approval. The board did this by narrowly scoping issues, removing cross-examination, refusing to compel answers to information requests, and by not testing evidence. Mr. Trudeau said the NEB overhaul would apply to existing reviews, that Trans Mountains would be redone. Kinder Morgan is not undergoing a credible review process. Kinder Morgan is not undergoing anything, and the people of Canada don't know why. Instead, a ministerial panel was sent to gather impressions as it traveled the pipeline route. Meetings were poorly administered and poorly advertised. The panel has no investigative powers or scientific expertise. Recent statements by National Resources Minister Jim Carr tell us the fix is in. He said that now his panel has heard from opponents that will lend credibility to the government's decision in December. Okay, there you go. See, I should have read ahead. It came 3 months after this. Sorry. Suggesting that 3 to 5 minutes in front of an ill-prepared ministerial panel is, and I quote Mr. Carr, the right process. That's an insult to the intelligence of the people of Canada. Canadians have not been given due process. Without due process, permission for Trans Mountain's expansion will never be given. The Harper government stacked the board with patronage appointments, gutted environmental legislation, and politicized the process. Trans Mountain's consultant, Stephen Kelly, was appointed to the board, even while the NEB review was ongoing. Lynn Mercier and Jacques Gauthier were reappointed, even though their terms did not expire until a month after the Liberal government was sworn in. Mercier, Gauthier, and board chair Peter Watson met privately with industry to discuss an Energy East strategy. This should put to rest any notion that the board is credible. The NEB parrots Kinder Morgan's economic narrative and how it uses this in its report to misinform the federal government. The economic cost of Trans Mountain's expansion to the Canadian economy, when properly scoped and fully tested, outweigh any economic gains. The board's report says the benefits are markets, a reduction in Canadian crude discount, government revenues, and jobs. The board puts these benefits up against residual environmental burdens and claimed the benefits exceed the burdens, so the project should be approved. Let's start with markets. There are 13 potential crude oil shippers. None provide evidence on where markets in Asia might exist. None said Trans Mountain's expansion will reduce price discounts, leading to crude oil price lifts. Offshore markets and a reduction in crude discounts because of them are an invention of Trans Mountain's consultants, Stephen Kelly of IHS, and then Neil Ernest of Muse Stansel. After relying on Mr. Kelly's report for almost 2 years, it was stricken from the hearing record when Mr. Kelly was appointed to the board. A few weeks later, Mr. Ernest's evidence replaced Mr. Kelly's. It told a very different market story. With Mr. Kelly's evidence stricken, the board said it would no longer consider it. The board refused to reconcile serious differences about markets from two consultants working for the same proponent at the same hearing. Asia does not currently receive Alberta's diluted bitumen. There is no Asian market for Alberta's oil. The board has been promised offshore markets by Kinder Morgan before. In 2011, Kinder Morgan said that if guaranteed access to the West Ridge dock was granted, offshore markets, with certainty, would develop. The board approved Kinder Morgan's application. The board hasn't bothered to check whether promises Kinder Morgan made were promises Kinder Morgan kept. If it had, it would know export commodity statistics show no Asian markets for Alberta's heavy oil. In its report, the NEB states 5 tankers per month are loaded at Westridge. There have not been 5 tankers a month since 2010. Fewer than 3 tankers a month were loaded in 2015 and barely 1 a month for the first half of 2016. And none of them went to Asia. So if markets do exist, why would oil producers sign 20-year take-or-pay contracts? Well, shippers only said they want the opportunity to develop markets, not that they exist. Market prospects have already deteriorated seriously from 2012 when shippers signed on. Oil prices then were more than double what they are now. Producers expected to supply a lot more oil. Why do shippers continue to support the project if market prospects have tanked? Well, they are contractually obligated to say they support the project even if they don't. And they must keep saying they support the project until after government approval is granted. If the board had read the contracts with the suppliers, it would know this. But the NEB panel never asked Trans Mountain to file the contracts at the hearing so it could read them. Unless the contracts were filed on a hearing record by Trans Mountain, the board would not consider them. The board relied on what Trans Mountain chose to reveal about the contracts and did not test to see if Trans Mountain's limited disclosure was reliable. The board drew erroneous conclusions in its report about the strength of shipper commitments and the need for the project because it relied on hearsay. Strong words. Had the board read the contracts, it would know Clause 3.2b says that if capital costs of the project exceed $6.8 billion, triggering tolls that exceed the open season toll limit, shippers can walk. Everyone except the NEB knows that Kinder Morgan raised the capital cost of the project to $6.8 billion. This happened in 2015. The board did not ask Kinder Morgan to provide an updated capital cost during the hearing. Why? Because it avoids obvious questions, and the board did not want answers. A $6.8 billion capital cost compromises the likelihood that shippers will be bound to their contracts. The board's refusal to consider a more accurate capital cost and the higher toll rates that come with it meant the board could accept overstated price lift benefits and pretend Canadian crude price discounts will be reduced. When accurate toll rates are considered, Mr. Ernest of Muse Stansel, his price lifts fall by almost 80%. The remaining 20% disappear because facts show price discounts for Canadian crude are within the normal range. They have nowhere to be further reduced. Now, diluted bitumen always sells at a discount to West Texas Intermediate, the standard North America WTI. Diluted bitumen makes a lower quality crude and costs more to refine. It also costs more to transport by pipeline because it is so dense. The crude discount is there because it takes quality considerations and transportation costs into account. So what about government revenues? The board claims $28.2 billion over 20 years. Well, Burnaby and other municipalities told the National Energy Board that property tax revenues will not be enough to pay for municipal services required by the project or the lost future planning and development options. The board ignored them. The board pretends property tax revenue is a significant benefit. Now, 84% of these projected revenues come from non-existent price lifts. The old story about we'll get more money for it. It's simply not true. $73.5 billion with a different methodology is eliminated. And if those price lifts aren't there, well, then neither is the supposed $23.7 billion in tax and royalty revenue related to it. In the proposal, Kinder Morgan said $100 million a year because it's claimed they pay corporate taxes on operating profits, but they do not. The board refused to look at a myriad of fiscal revenue losses when other sectors are negatively impacted by the project. It ruled them outside the scope of its review. There will be short-term construction employment related to the pipeline. However, Unifor, who represents 12,000 energy sector workers and 5,000 West Coast commercial fishing workers, and the Alberta Federation of Labor, who represents 170,000 unionized workers, they don't support this project. Unifor and the AFL said there will be a greater number of job losses in construction and permanent employment if the project proceeds because it robs our economy of value-added opportunity and crowds out existing activity, particularly in commercial fishing. The board ruled workers' concerns are outside the scope of their review. Kinder Morgan told the National Energy Board 90 permanent jobs would be created, with 50 of them in BC. But the NEB didn't rely on the 90 permanent jobs Kinder Morgan identified. It relied on grossly exaggerated figures from a faulty input-output analysis done by the Conference Board of Canada to assert 443 permanent jobs instead. Now, under a proper scope of review, where an energy strategy for Canada and job losses across industries are considered, the job figures become negative. Facts show there are no existing Asian markets for Alberta's crude oil. No reduction in crude discounts to be captured. A likely net reduction in government revenues and net job losses. These are not greater than residual environmental burdens. Facts show the project should be rejected, but the board refused to consider the facts. The federal government is betraying Canadians by not living up to its promise to redo the Trans Mountain Review and by continuing to endorse the National Energy Board. Canadians are not stupid. Our public interest must be served. And as there are numerous accounts at the conclusion of that statement to that town hall, Robyn received a standing ovation. I've got a few more minutes to fill before we have to go to the interview. I just want to talk a little bit about the toll situation. This is such a sweet deal for Kinder Morgan because they get guys on both ends. Now, this is another one of Robyn's columns from August 2015, and it says, NEB stacking deck in Kinder Morgan's favor. The NEB made decisions in 2013 that pervert market signals. It approved Kinder Morgan's toll methodology for determining rates on the expanded Trans Mountain system. These higher toll rates apply not only to the new pipeline, but also to the 65-year-old legacy line. After Trans Mountain expands, it will cost a company such as Chevron almost twice as much to ship a barrel of oil to its Burnaby refinery as it costs today. The NEB also approved the terms embedded in the long-term take-or-pay contracts Kinder Morgan has with shippers. Companies have contracted for 707,000 barrels a day of the 890,000 barrels available. All but one have signed for 20 years. If this project proceeds, these shippers have no choice but to pay up every month for contracted capacity, whether or not it makes business sense to physically ship down the lines. The new pipeline could sit empty, but Kinder Morgan would still book vast returns. It plans to siphon more than $800 million a year from the Canadian economy to its head office in Houston. Meanwhile, these long-term take-or-pay contracts represent an ongoing cost for Canadian oil producers and marketing businesses of more than $20 billion over the life of the contracts. There are clauses in the agreement that allow shippers to terminate, but the financial viability of export to foreign markets is not one of them. If shippers wish to back out of their agreements because of low oil prices or lack of production, they need to rely on other circumstances to trigger the limited termination opportunities. So it's the NEB that locked in the suppliers. Now, what about on the consumer side? Excuse me. This is a column from the Vancouver Sun that Robyn wrote March 20th this year. If you remember, in March there was a little short news cycle about if you want to keep gas prices down in Vancouver, well, you better build the TMX. Robyn took the opportunity to take someone to task that I highly agree with taking to task. One hypothesis reported in the Vancouver Sun is that Trans Mountain expansion will bring relief for lower mainland gas prices. Dan McTeague, who operates the Gas Buddy website, is quoted as saying that twinning the controversial line could be the only viable option. Regrettably, Mr. McTeague is unaware as to what Kinder Morgan and its potential shippers explained to the National Energy Board during Trans Mountain's review of what the purpose of the project is and how it will be funded. If Trans Mountain's project proceeds, it will raise local pump prices, not lower them. The negative impact from the expansion when it increases pump prices for BC residents was brought forward by interveners during the review. Certainly most Canadians expect that an increase in the retail price of petroleum products, when the product represents no benefit to the local market, would be considered by the board as a cost, and this cost would be factored into its decision. It was not. Kinder Morgan acknowledged that higher gasoline and other petroleum prices facing end users is of interest to the public, but they concluded they were not a public interest concern the board need consider. The board agreed. The NEB has been fundamental. Thank God a court overturned Northern Gateway. Because having talked to Robyn, you think Northern Gateway was bad for lack of process and bullshit? It's nothing compared to Kinder Morgan. That's enough for me. We do get into other subjects, but I'm going to let that interview roll. Here we go. The View appears very pleased and honored to welcome Robyn Allan to the show. Hello, Robyn.
Hi, Glenn.
Well, it's great to have you here. I've tried to get across through the background in the first half of the show. Kinder Morgan is a very complex entity. It doesn't seem to me like it was set up simply to do business and try and make some profits. It seems to have a different purpose. I mean, set up in 1992 as Enron Liquids Pipeline LP, right from day one they said it was a tax shelter and used duplication of deductions across their different companies. As time went on, the United States Joint Committee on Taxation in the Enron investigation cited Richard Kinder as creating this shell game. Is this something that Richard Kinder is well known for? Is this his whole purpose? 1997, Kinder and William Morgan buy the assets from Enron while being paid by Enron. They created an insider board. They filed a prospectus to the Security and Exchange Commission, and they used the natural resource exception to basically create a bulletproof tax shelter, a pass-through entity, and that's what allowed their massive growth into the third largest energy company in North America. Robyn, like to this point in time, when you see this happening, as an economist, what do you think the game is here?
I think that it's very clear that Kinder Morgan, learned a lot of techniques while at Enron to minimize their tax liability and to minimize their liability for other responsibilities in business. And so they really levered off non-market activity to generate their returns and to expand their growth. And so, you look at the market and you say, well, the market provides really good signals about what activities society wants and needs. But when companies start to rely on non-market activities like maximizing the play of the tax system or using the regulatory agencies to try to reduce scrutiny, that distorts the market. And we start to see a company being able to engage in pipeline development, maybe in conditions where the market says, enough. And I think what we've seen in the last number of years here in Canada is, had this been a company that relied on market signals and the need to raise capital in the private sector and the need to pay proper taxes, fair taxes, that they wouldn't have advanced this project because it wasn't economically viable from the beginning. So we really see that over a number of decades, and the history you're recounting is accurate, that they've relied on distortions to bring this project to where it is now, and that has added increased pressure for people in Canada to try to push back and say, no, we don't think this makes sense, and we don't want it for various reasons. But because of the history of this particular company, this project got way further than it should have under sound market conditions.
Now, in 2013, there was a consolidation, and Richard Kinder himself called it a tax shelter. And if I'm correct, what they did is buy assets from the other companies at a new value, and they depreciated them as new, despite them not being anywhere near new. And Richard Kinder himself boasted that this would save $1.4 billion a year for 20 years by doing this. And it seemed like he was correct when the day after this deal closed, Richard Kinder pocketed $800 million in one day. So, I mean, how can a company like this keep going in the markets and get away with this stuff and they don't get reeled in? I don't understand it. How can they keep doing this from 1992, They've been doing the same tricks, but yet it's allowed to go on. Is this just artful manipulation of tax law?
Yeah, it's all legal. To the best of our knowledge, everything they're doing is legal. Because they're playing the advantages that are set up in the system to support, for example, we know the fossil fuel industry is subsidized, and it's subsidized extensively.
Yes.
And so they are taking advantage at every opportunity of the facilitations that are in place. And we will get into this. For example, we have a situation where Kinder Morgan is structured in Canada to avoid taxes because it's a cross-border company. It's a U.S. company that operates in Canada, so it can take advantage of the International Tax Treaty in a way that if it was a Canadian company, it wouldn't. We've got a company that says to the National Energy Board when it comes forward with this pipeline, it says, well, this pipeline will provide tax dollars, corporate tax dollars, to provincial and federal treasuries. They do it based on a model that doesn't even reflect how they're structured. So they come to the National Energy Board and say, we're going to have billions of dollars in tax revenue over 20 years, but they pretend that they're a Canadian company operating only in Canada and being taxed at the highest corporate tax rate. Meanwhile, they're structured to avoid taxes almost altogether. And when I brought this up to the National Energy Board and said, well, on the one hand, Kinder Morgan's saying, here's the tax benefits from this activity. On the other, they're structured not to pay them. There's a huge disconnect. And the National Energy Board goes, well, that's outside the scope of our review. We're not going to look at that. And so you see, Kinder Morgan is able to rely on regulators that have been co-opted. So it's not just that they take advantage of tax laws and structure themselves in a complex way to do that. They also take advantage of regulatory agencies that have been captured by the industry, that are no longer doing their proper job. And so we see a series of misrepresentations, pretending that they're going to contribute tax dollars to the Treasury, which most Canadians are concerned about. They want healthcare and education and other government services. But Canadians are being duped because this project will not generate tax revenues. It wouldn't have when Kinder Morgan owned it, and it certainly won't now that the Canadian government owns it.
Well, is not their takeover of Terracin a perfect demonstration of the way they can? I mean, Terracin was a publicly listed Canadian corporation. They delisted it, they bought it lock, stock, and barrel, and they basically turned it into an American MLP, so they took that entire corporation basically out of the purview of Canadian authorities, the Canadian public, Canadian investors, and absorbed it and turned it into just another arm of this deceptive we take, we don't give. Isn't that a perfect demonstration of the way they do business?
Oh, exactly. And you've identified a very interesting situation back in 2005 when Kinder Morgan bought what was then Terracin. Now, you see, a couple of years before that, they needed changes in the laws to allow them to do that. There were restrictions about a U.S. company buying up a company like Terracin that was based in British Columbia. It had its board of directors here, a head office. So we actually see the provincial government under Gordon Campbell changing the law to allow Kinder Morgan to buy up that company. So they buy up the company, and they really only wanted the Trans Mountain assets. They didn't want all the gas assets. They just wanted the pipeline and related activities. So they buy it up in 2005 after the laws have been changed to allow them to do so. They deliberately buy the shares of the company instead of the assets, because if they'd bought the assets, they would have been subjected to higher taxes. So they come in and they buy up the shares, and they avoid National Energy Board scrutiny when they do so, because the National Energy Board, for some strange reason, says if you buy the shares, you don't have to get approval from us. And then 2 years later, after buying it in 2005 and 2007, they sell all the gas-related assets to another party, keep the Trans Mountain assets, and then they drop them down to the MLP, the Master Limited Partnership in the States, which is a particular structure that avoids taxation. And so, we see this continuous, very extensive structural changes that are simply put in place to minimize the taxes that they would have to pay and therefore minimize the contribution to the Canadian economy. So yeah, absolutely. The purchase in Terracin was another example of governments bending over backwards to facilitate this company so this company can make huge gains to provide returns to their shareholders, predominantly who are in the United States.
So the result is Trans Mountain has no Canadian reporting duty to securities or financial authorities, and Trans Mountain, despite, for example, in 2013, having $168 million in revenues, in fact, from the Government of Canada, got a $3.5 million tax refund. Is this proof of their shell game? This is what they're looking for?
Well, yeah, and that's really very interesting because, again, if we go back to the way this project was initially sold to the Canadian public as being beneficial was the contribution to fiscal revenues. Kinder Morgan, predominantly U.S. shareholders, because the master limited partnership structure that existed in the States does not benefit Canadians. So that we find that their shareholders and their unit holders are predominantly U.S. So we don't have any reporting, as you said, because they were a U.S. company in Canada. There isn't a disaggregation, say, of the Trans Mountain assets, so we could look at how much money they were making and how much money they were taking back to the state. But what we do have is a investor analyst conference that was held when Kinder Morgan was trying to tell their U.S. shareholders just how advantageous Trans Mountain's expansion would be. And so Ian Anderson, the then president of Kinder Morgan's Canadian activities, did a presentation, and he provided data that showed us how much money the Trans Mountain activities were making and how little tax they were paying. So over a 5-year period, what we were able to see was that on average, when that company earned an average of $172 million a year in what they called distributable cash flow, which is their metric for profit, $172 million a year, and they paid an average of $1.5 million in taxes. That is almost a zero effective tax rate. That's how successful this company has been in playing the system to minimize their contribution to the society that makes it possible for them to make money.
Well, as Richard Kinder said himself, this entire umbrella organization consists of more than 250 corporate entities. In your time as an economist, as an intervener, as an investigator, have you ever seen a corporation quite like this one that is so obvious in pocketing profits above all else? Well, besides Enron. Like, is this obviously a child of Enron?
Oh, no, there's no question that this business model is based on the Enron's model. No question at all. In fact, Richard Kinder was very instrumental, at Enron, in developing accounting practices that were able to avoid tax revenue. And he's been identified by the U.S. authorities as having been part of that strategy. The thing with Enron is they took it so far as to be found fraudulent. Now, fraud is very difficult to prove, and fraudulent activity is illegal. So, there's some argument for Kinder Morgan having learned how to make sure they don't cross the line. You would hope that there is nothing that they're doing is illegal, and certainly I'm not suggesting they are doing anything illegal. What they are doing is taking advantage of the system extensively and focusing a lot of attention of their business activity on doing that. And when you do that, you focus less attention on safety, less attention on other prudent business practices. And because there's only so much time and effort that can go to certain aspects of your business. So it's not unlike, say, a company that spends a lot of time marketing their product instead of producing the best product. Your focus goes to certain activities, and it reflects your culture, your corporate culture. And so what we have is a company whose corporate culture is focused on how do we take advantage of the system to maximize our return, not how do we perform as the best corporate entity from a business perspective to maximize our return. And so what we see is, in fact, that they are a pipeline company, but really the company is more like a financial company, more like a tax planning company than it is a pipeline operator. And that's what they focus their attention on. So yeah, it creates a corporate culture that has a disdain for the public. If you're focused on how to minimize your contribution to the fiscal purse as a way to maximize your return, it reflects a certain amount of disregard for society. That you don't feel that it's your responsibility to contribute back to the culture and the society that allows you to make money. And when you have that kind of attitude, it permeates your entire organization. And so it's not a healthy culture.
Now, when you look at the different ways to achieve profitability, especially with something like a pipeline, is seeking tax avoidance the easiest route to go when you look at other things such as pipeline safety, compliance with environmental laws, compliance with stakeholder consultations, following rules? This is just simply the quickest way to the most money. Is that the best easy way to describe it?
I think certainly there is a deliberate attempt to structure your organization to avoid liability, whether it's tax liability or liability for spills. And so as I say, there is a kind of permeating this whole thing is a disdain for the public. It's like an elitism. It's, when we look back to Enron and they had a culture where they thought they were the smartest guys in the room. And that's true. These guys are very clever, and predominantly guys. I mean, there's a senior executive that's female, but these people are very clever at structuring their organization and deals that they enter into. And they do it to maximize returns and minimize liability. And I'll just give you an example. There was a pipeline that they owned in California a number of years back that it suffered an explosion, and there were a number of workers that were killed. Kinder Morgan argued that their liability was limited because of the way they were structured. They had different, a number of these corporate entities, there were over 250 in the States. And these limited liability corporations, they were trying to argue that they weren't responsible for paying compensation to account for these workers that were killed. Because of their corporate structure, they were limited. So you couldn't move through the number of entities and get up to the entities that actually had the money to pay. And they forced the families of these workers to go to court and sue for compensation. Now, these families ultimately won. But to suggest you're the kind of company that, takes safety foremost and then has a respect for the community and then just force people to go to court to get reasonable recourse is contradictory. And it's not unlike the situation that happened in Burnaby when the backhoe ruptured their pipeline and a neighborhood was saturated in oil. Kinder Morgan was at fault, and they still took the city of Burnaby to court. So a kind of a frivolous court case to make it difficult on the community when they knew full well they were responsible. So the duplicity is recorded in so many actions where they say one thing and they actually do another. I'll give you another example. We've been told for years that there's an average of 5 tankers a month that dock at Westridge, the dock that ships oil to Tidewater. Yes. 5 tankers a month. They keep saying this. They said it at the NEB review. There have never been an average of 5 tankers a month over a year at Westridge, ever. In 2016, they only had 15 tankers for the whole year. That's an average of 1.25 a month. And I've asked Kinder Morgan numerous times for statistics and they refused to give it. But when it was brought to their attention that they didn't have those tankers, they just skirt it. They don't say, you're right, we weren't telling the truth. They just skirt responsibility and mislead the public. Now, the reason why it's important how many tankers a month are at the dock is they've been saying that there's a huge demand for Tidewater access. Well, the National Energy Board approved up to 79,000 barrels a day of guaranteed access to that dock. And that's about 4 to 5 tankers a month. Well, when there's only 1 tanker a month, that the dock isn't being used. That dock space is, in 2016, less than 30% of it was being used, which means, yes, the land access is being used to, say, Washington State and the Lower Mainland, but there isn't a demand for Tidewater access. And this project keeps being sold like there's this excess world demand for our oil, and we just need to get it on tankers, and then we'll have euphoria in Alberta. When the Tidewater access isn't being demanded worldwide, you got to ask your question, why is this expansion necessary? Because it sure isn't going to get a higher price in Asia, and it sure isn't being used now. So again, Kinder Morgan sets up these claims that exaggerate the need for this project and minimize the harm that it will do to our economy, our financial markets, and our environment. And that's the consistent approach they take, and it's not fair, and it's not right.
Well, one word you used there was duplicity. And using that word, it's time to talk about the National Energy Board. I mean, you were involved with the process for Northern Gateway. You saw the games that were played there. You were involved with Kinder Morgan as an expert intervener until you left that process for what you described as fundamental flaws in the system. I see this very similar as to the games that are played with the CRTC and them bending over backwards for anything the big three in Canada want for data and cell phone rates and everything else. I mean, just looking at the simple facts from this NEB process, at the very start, Kinder Morgan demanded a 12 to 15% rate of return or the expansion would not go forward. Now, Kinder Morgan just said, okay, that seems reasonable. This resulted in the exorbitant toll increase approved by the National Energy Board on a 65-year-old pipeline. Now, at the end of the day, there's nobody else who's going to pay that except consumers. Is that correct?
Yes, if the project proceeds, the National Energy Board has approved a toll methodology that would see the tolls on the existing line that service the lower mainland of British Columbia and the refineries in Washington State. The tolls to deliver the same oil to markets today would more than double. And what we do observe is that when toll rates go up, those are passed on to consumers. So, for example, in British Columbia, I've calculated that the negative impact on our economy in BC will be about, just for gasoline alone, about $100 million a year. So that's $100 million a year to the BC economy that the National Energy Board refused to recognize when it looked at the benefits from the project. So the National Energy Board approves this project based on benefits to oil producers in Kinder Morgan without looking at any of the economic costs to the BC or the Canadian economy. And there are huge costs that have never been recognized. So every time we hear these, you know, when Prime Minister Trudeau or Premier Notley talk about benefits to the economy, none of those numbers ever include any of the obvious and real costs. And when we look at those obvious and real costs, there are good reasons to believe that they actually outweigh the benefits. And so that this project will actually be a negative net impact on the Canadian economy, and it certainly isn't in the public interest from that point of view.
Is the simplest way to describe this moving forward, quote unquote, is the National Energy Board is approving a subsidy paid for by the Canadian public to move this project forward? Is that the easiest way to describe it?
Yeah, this project from the beginning has required subsidies to make it move forward. So let's just start with the very first major accommodation for this project that broke the market signal. So when we look at a project like this, like a transportation project, and whether or not it's in the interest of the Canadian economy, you want to say, well, will it add value? Will it add benefit to the Canadian economy? And if so, then that's one of the reasons why you might want to see it approved. From the very beginning, Kinder Morgan knew this project would likely not make it. We have quotes from Richard Kinder saying, you know, in this day and age, back in 2010, he said it would be very unlikely to be able to put a pipeline through a major urban center. Well, certainly Burnaby and the lower mainland of British Columbia are major urban centers. And he also talked about how it would be difficult to finance. So what did they do? They came forward back in 2010, 2011, and they asked the National Energy Board to approve a special fund Now, this had never been done before. It was an unprecedented request that the National Energy Board granted, which allowed Kinder Morgan to charge extra tolls for oil deliveries to the dock. And again, whether or not that oil was delivered there, we had 5 oil producers that had signed 10-year contracts, and they agreed to pay tolls whether or not they delivered the oil to the dock. They could deliver it to other markets by land. The point is that the National Energy Board approved about $28 million a year to this fund, and that money was going to then be used to pay for the regulatory process when they brought the project for the expansion forward. And the reason it was unprecedented is that, and even the oil producers went to the National Energy Board and said, we don't want this fund because it breaks down market signals. If Kinder Morgan wants to advance a project for the benefit of its shareholders, it should go to the capital markets and raise the equity to do it. And it should bear the risk. But the NEB approved this fund. So right now we have $220 million of the capital spend to date that is paid for by this fund that's been collected over the years. So that's the first example of a kind of a cross-subsidization of the project that on its own wouldn't have been brought forward. Then we see the tolls. That's the second obvious example of subsidization of this project, that you've got the existing assets of an existing pipeline that serves a market in Canada and the US that are going to more than double to help pay for a pipeline that is intended to serve world markets by tanker. So now you've got the BC economy and to a certain extent the US Washington state economy subsidizing a pipeline for other markets, new markets. So that's another example. Then we have a situation, of course, that's just happened where the Canadian government has come in and bought it out at a premium price using taxpayer money to do so, further subsidizing it. And then we have, for example, the Oceans Protection Plan, yes, which is a $1.5 billion expense over 5 years. Now, this means that, you're going to have to spend, to keep this plan in place, every 5 years, there's going to have to be another allocation of taxpayer money. So it's only $1.5 billion for the first 5 years. And certainly not all of that is because of Kinder Morgan. There's some protection on the East Coast and the North Coast. But predominantly, let's say at least $1 billion is just because of the tanker traffic triggered by the expansion. So you've got that subsidization directly of taxpayer money. And then there's a land-based spill and the monies that are required for that. So by the time you add it all up, it's the Canadian taxpayer that is heavily subsidizing what should be a private sector initiative for the benefit of a number of oil producers in the oil sands. And consistently, they try to pretend this is a private sector endeavor that's going to contribute public benefit. And all I've seen to date is public cost benefiting private initiatives.
As the NEB process moved along in the early stages, with the claims of new markets that this would enable, the 13 shippers that had signed on to this project supplied absolutely zero evidence that new markets existed. And then we find as things moved along, they said, well, we were just looking for the opportunity to develop new markets. So they really don't exist. And then we have the issue of one Stephen Kelly, whose IHS report was accepted lock, stock, and barrel by the NEB without any real desire to look into what it said. And then we find out that the same Stephen Kelly is appointed to the National Energy Board. Someone working for Kinder Morgan is appointed to the board. How can they even claim legitimacy when they do stuff like this?
The National Energy Board is such an unbelievable story of the downfall of a regulator. It is such, to have watched what's happened in the last 5 or 6 years with the National Energy Board and how they have desperately sought ways and means to pretend that their decisions are legitimate when they're really there to support Kinder Morgan and its project. So you have the situation you just identified, that the National Energy Board was told by Kinder Morgan through its consultant, Stephen Kelly, that there were potential for new markets. And ironically, Mr. Kelly's evidence put forward at a prior hearing said just the opposite. So we have a situation where the National Energy Board has to approve the toll methodology that's to be applied for a project such as this. And then it also has to approve the public interest. And those can be under two separate hearings, which they were in this case. There was what they call the Part 4 hearing for toll methodology. Kinder Morgan underwent that before it did the Part 3 under the Act public interest review. Now, in the Part 4 hearing for toll methodology, the National Energy Board wouldn't allow parties such as myself or the City of Vancouver or Burnaby or environmental groups or other directly affected people to be involved. They said, no, this is a toll hearing. We're just going to have the shippers basically, and then, the Canadian Association of Petroleum Producers, the lobby group for the industry, and we'll let Kinder Morgan and the shippers, all these people play. But you other interested parties, you'll be heard at the public interest review, and we're going to exclude you. And so what's interesting is when you read the transcripts, because at that hearing they actually had cross-examination, which means it was a hearing. Cross-examination was not allowed at the Part 3 hearing, and it effectively means there was no hearing because you couldn't actually test the evidence. But at the Part 4 hearing, what we see is that Kinder Morgan was trying to prove that they didn't have an unfair advantage over shippers because there were lots of competitive transportation systems that would be available. And what we see is that Stephen Kelly, who was their consultant then, comes forward with evidence basically saying, it's going to be hard to create markets in Asia. They don't already exist. And, to think this, and this is paraphrasing, a pot of gold at the end of this rainbow, well, it's not there. And he also argued against what they call netback analysis, which is the analysis that has given us these huge benefit numbers. The $15 billion a year that Prime Minister Trudeau erroneously quotes, it either because he doesn't understand how the market works or he's deliberately trying to deceive Canadians, that those numbers all come from this so-called netback analysis. And Stephen Kelly at the Part 4 hearing said, when you've got kind of market structure we have now with a lot of long-term contracts, you've got access to TIDEWATER in the Gulf, you've got companies that supply their own refineries, netback analysis isn't relevant. It's not relevant. It's not as useful. It doesn't properly reflect what's going on. But then when it comes to Part 3, when the hearing is trying to prove this is in the public interest, Mr. Kelly changes his evidence. Now, I tried as an intervener to get his evidence in the first hearing on the record, because if evidence isn't on the record, the panel can't look at it, they can't assess it. And I tried to get Mr. Kelly's Part 4 evidence that contradicted his Part 3 on the hearing record, and Kinder Morgan said, no, it's not relevant, and the board agreed. Then we find Mr. Kelly is appointed to the board of the National Energy Board, having been a consultant at the time a hearing is ongoing, which is huge conflict of interest. Yeah. And so what the board does is they strike Mr. Kelly's evidence from the record. So now after months and months of evaluating this evidence, it's no longer part of the hearing record. And Kinder Morgan comes forward with a new consultant to replace Stephen Kelly. And it was Neil Ernest of Muse Stansell. Now, his evidence contradicts Kelly's in a number of places. But when I tried to get the board to look at the fact that Kinder Morgan's new consultant contradicts their old one, and therefore that should suggest there's a lot of questions about the evidence, the board refused to do so because it said it struck Mr. Kelly's evidence from the record. It was no longer relevant. So that's the kind of game playing that goes on. And you have a perfect opportunity to show that Kinder Morgan is trying to pretend markets exist when they don't, and that the prices in those markets are higher when they're not, by showing consultant evidence that Kinder Morgan also bought and paid for, and the board won't allow it. So it really makes it difficult to discredit the evidence that's on the record when it's clearly discreditable. So that's one example of how the board manipulated a lack of scrutiny of the benefit evidence. And then, as you mentioned also, the shippers. Yes, there are 13 shippers that signed long-term take-or-pay contracts. All but one are for 20 years. There's one for 15 years. where they promise to pay for that capacity whether or not they use it. And that, underpins the project, but that's for 707,000 barrels a day. But you see, of those 13 shippers, at least 4 of them currently ship along the pipeline. And all they wanted to do was to take their capacity that they already use and take it from being bid every month to being under long-term contract. So when we look at it, really, this project isn't nearly as supported by a demand for new space as it's pretended to be. Probably somewhere near, 200,000 barrels a day is capacity that's already being used on the existing line. So, to suggest that those shippers that want to ship gasoline to the Lower Mainland or those shippers that want to ship to their refineries in Washington State, those are not new markets. So what are the potential new markets? Well, every single shipper, and there was only about 2 pages each of evidence that they supplied. They supplied a very minimal amount of evidence on the hearing record. They left all of the evidence really to Kinder Morgan to hire consultants to deliver. So what we find is that the shippers say, we believe that we need this project because it gives us an option. Not one of them said they would get higher prices in Asia. Not one of them said where the markets other than Washington State and BC were, but simply we want the option available to have access to markets. And so, if Canadians really understood that this project is simply about another way to deliver heavy oil to market, and those markets may not exist, and that in fact to develop those markets it might cost the producers more, because we all know that when you're trying to develop markets you got to lower your price to get in, then this project would never have been approved. That if it was really understood that it's about options to deliver product to new outlets, then it would not have been approved.
Well, I find this just amazing from a corporate viewpoint. I mean, just to sum it up, here's Stephen Kelly with fictional evidence in a hearing that doesn't involve the public, that is accepted by the National Energy Board on face value. Then Stephen Kelly gets appointed to the National Energy Board, and that evidence that they accepted is struck from the record, so it no longer exists. We're done with part 3. Yeah, we're moving on. And now we're into part 4 with new evidence that they knew was not as inflammatory, and they have the balls to say that they're objective. I mean, what I see is blind acceptance, no investigation, and purposeful omission of relevant evidence as the process moved on. One of the worst things that stood out to me was the refusal of the National Energy Board to accept increased project estimates for the cost. Why would they do that?
Oh, okay, yeah, and just to clarify earlier, the Part 4 hearing for toll methodology took place prior to the Part 3 hearing.
Yes.
Okay, and then in the Part 3 hearing, where some members of the public were allowed, there's a couple of things I just want to say about the Part 3 hearing that shows how it was not legitimate. In the Part 3 hearing, they only let some members of the public, where historically they let pretty much anyone who felt that they were directly affected. And they didn't allow cross-examination at the Part 3 hearing, so you could not properly test the evidence. And then when they replaced Kelly's evidence with evidence from Muse Stansell, they didn't allow it to be tested for any real length of time. And so you have this buildup of situations where effectively, you're quite right, the board approved this project without having the evidence properly tested and by exaggerating the benefits that Kinder Morgan basically said were going to come forward from it. And so then we're into a situation, for example, around the financial viability of the project. So you've got I like to think of it as 3 basic sectors. You've got, what's the environmental impact of this project? What's the economic impact on the economy? And what's business impact, or is it financially viable? Can you construct this project at a reasonable cost and have reasonable tolls charged over a number of years to pay for it? So when we look at the financial viability, did this project make business sense? And if it had been evaluated from the beginning on the basis of does it make business sense, it wouldn't have proceeded because it isn't commercially viable. And one of the ways we know this is the capital cost of the project has consistently risen. So when the project was put to the National Energy Board at the Part 3 public interest hearing, the capital cost, which was the same as in the Part 4, was $5.4 billion. So 5.4 billion Canadian to build this project. Over the course of the hearing, and it related to the restructuring you mentioned in 2013, we find that Kinder Morgan restructures. And Kinder Morgan had always told the board, you know, we've got a $5.4 billion project, and we are going to finance it. We're going to provide the debt and equity through our head office in Texas, no problem. This is a slam dunk, totally financeable, and we're going to provide the financing. Then over the course of the hearing, Kinder Morgan restructures and becomes unable to finance the project because its debt was so high, it couldn't go to the market and raise construction financing, and it couldn't go to the market and raise equity, and it didn't have the internally generated funds from its operations to do so. So now the promise of financing it is broken, and then we find out shortly thereafter that the capital cost has gone to $6.8 billion. Well, as I said earlier, if the evidence isn't on the record, the board won't consider it. And at no time did Kinder Morgan come back to the board and say the project cost has gone up to $6.8 billion. And by the way, we can't finance it anymore. We're going to have to find a different way to get the money to build this project. Well, they didn't do that. And the board, and this is where it's highly questionable, the ethics of the board are highly questionable because the board has the right to ask any questions it wants. And it never once said to Kinder Morgan, has your cost gone up and can you still finance it? Never once. Even though interveners questioned Kinder Morgan on these things and raised the fact that capital costs were going up and their ability to finance was being compromised. And I even filed motions requesting that the board evaluate this issue, and the board refused. So now we have a situation where the costs are $6.8 billion, Kinder Morgan can't finance, and the board should have known this, and it should have been on the record a good 6 months to a year before their report comes out. But in May 2016, they write a report, and they still pretend that the project costs are $5.4 billion, and they still pretend that Kinder Morgan can finance it.
That seems like just, to me, obvious ignorance of evidence that is out there in the business community. Kinder Morgan said things themselves that the NEB just simply did not choose to listen to. One of the other things that really surprised me about the NEB process was over jobs. Now, Kinder Morgan put out a job forecast themselves, and it basically said we got around 90 permanent jobs. That's it. But what shocked me was the National Energy Board found those numbers to be too low. So they used numbers from a Conference Board of Canada report, which were higher, and accepted those as correct instead of the ones from Kinder Morgan. How does this happen?
Well, this happens because the National Energy Board allows economic models that do not reflect reality to be relied on. They allow those models to be relied on. And those models, the one the Conference Board used is called an input-output model. And when you understand how that model works and what it can and cannot tell you, you know that the job numbers that have been bandied about are bogus. And so what we have is, again, another contradiction in its consultant's report from the Conference Board. The Conference Board uses an input-output model to predict jobs without properly taking into account the number of jobs that will be lost because of this project. So there will be significant job losses because this project proceeds. But the Conference Board model does not consider those. So this takes us back to the general theme that keeps going on here, where all benefit, kind of gross benefits from the project are relied on, but costs from the project are ignored. And so you don't have a net impact analysis, you have a gross benefits analysis. It would be a bit like saying, you know, I have a company that earns $600 million a year in revenue. And then somebody says, well, but what are your expenses? And I say, well, those are irrelevant. My expenses are $1 billion, so I actually lose $400 million a year. But, you know, don't worry about that. This is $600 million in revenues. Isn't that great? So that's the analysis that Canadians are being fed. And it's toxic in the sense that it's bad information and it allows people to make choices that are going to affect them for decades, that they think that it's going to be good, but in fact it's not, because there's actually a net negative impact. Whether it's when we look at the financing of this project, and the fact that Kinder Morgan couldn't raise the money themselves, and if the board had done its job during the review, they would have flagged that as a red flag for the Canadian government and said, this project is financially compromised, and therefore we think it shouldn't go forward. But no, the NEB relies on false numbers and says, we believe it's financeable. And then we find out now, in 2018, it's not. Mm-hmm. And I can talk a bit about that in a minute. But there was no way Kinder Morgan could raise the money it needed to proceed with this project. It just couldn't do it. And so even though the government tries to suggest that they bailed it out because of the province of BC putting roadblocks in the way, even if those roadblocks weren't in the way, this project wouldn't have been able to be proceeded with by Kinder Morgan for financing reasons. But the 90 permanent jobs is exactly what Kinder Morgan says will occur from this project, 50 of them in BC and 40 of them in Alberta. And the thing is, some of those jobs are already filled. Yes. They're already existing because of the current pipeline. But then Kinder Morgan, in one part of its report, I think it's volume 5, says we're going to need an average of 2,500 workers constructing the project for each year for 2 years. So for 2 years, we'll have about 2,500 construction jobs, short-term jobs to build it. But then the conference board report puts these numbers like at about 50,000 plus person years. They call them jobs. They're not jobs. They're person years of employment. But because they use this input-output model that is flawed fundamentally for the evaluation at hand, they come out with a figure that is 20 times larger than the figure that's also in the same application. It's not like it was a different analysis done at a different time. It's in the same application provided to the NEB, so it's on the hearing record. But the NEB goes to the conference board numbers, not to the numbers that Kinder Morgan actually put into the volumes for the impact on jobs related to actual construction activity. So, you know, they like to talk about it as direct, indirect, and induced employment from the spending of the money and all sorts of terms that would make it suggest that the analysis is appropriate. But as I said, the analysis isn't appropriate if it doesn't also look at the job losses, the jobs that are crowded out in BC because, for example, you know, the tanker that has to move through the harbor is now interrupting commercial fishing, or the tanker moving in the harbor is now interrupting tourism. The fact that these tankers are predicted to kill off the orcas is going to change the number of employed people in whale watching. Like, none of that is included.
Well, the thing that really strikes me is you want to talk about the NEB. Whenever they run into a tough question, they say that's beyond our scope. Yes. I can see nothing beyond their scope more than accepting these conference board numbers. That is ridiculous. They should be accepting the numbers from the corporation that is proposing the project, should they not? Well,
they should accept those numbers, or else allow for the evidence that says the conference board's numbers are fundamentally flawed. And in other words, are overly aggressive and have excluded certain costs. So for example, they would not allow, and I tried in my questioning, they would not allow for some of the displaced workers that would arise because of the conference board approach. So let's just take, for example, Kinder Morgan told the board that if the pipeline wasn't built, the oil would be getting to market by rail instead. So that may or may not be true. I mean, there's no evidence to suggest that there's any way that there will be heavy oil coming into BC by rail if this project's not built. We don't have the ability in the marine environment to put it onto tankers by rail. There's just no way that oil is going to come to BC through rail. But that's the model that Kinder Morgan presented through its consultants. Said the same amount of oil is going to be produced out of the oil sands, whether or not the project's built. So if it's not coming by pipeline, it's coming by rail. That's what they said. Well, if that's the case, then CP and CN are going to be employing people to run those trains. And they're going to be employing people to load those tankers. And so if you build a pipeline that then displaces that activity, you're going to have layoffs in the rail sector. And the National Energy Board refused to look at that because they said that is outside the scope of our review because it's not about the pipeline. So again, so there's Kinder Morgan creating an inflammatory scenario. Let's face it, they pretended that this oil by rail is so much more dangerous. They create an inflammatory scenario that if it doesn't come by pipeline, it's going to come by rail instead, which it can't physically do. Mm-hmm. And then they predict benefits when pipeline displaces rail, but will not look at the costs that would naturally occur if that happened. And so you go through stage after stage after stage of false representation that leads to a very positive number for Kinder Morgan, which has no basis in fact and no basis in reality. And if you were to take the analysis to its logical conclusion, you would actually contradict Kinder Morgan. So no matter how you look at it, the numbers don't make sense. And still, the board pretends in their report that they do. And then Ottawa, under Justin Trudeau, continues to pretend that they do.
Well, as far as accepting things that are demonstrably false, I wanted to just mention with the Muse Stansel report, it came up with some pretty exorbitant claims, but it did say in the report quite plainly that if other pipelines were built, it would invalidate the claims of the report. And what has happened since then? Donald Trump has put Keystone XL back on the table. Line 3 is happening. So isn't that right there? Oh, our report no longer applies.
Well, yeah, I mean, it's very interesting because the Muse Stansel report was not properly tested at our hearing, but the same approach to analysis for the need of pipeline, Muse Stansel did for Line 3 in Minnesota. And the report was under cross-examination, completely discredited. His analysis, very similar to what he did for Trans Mountain, was discredited. It was also under cross-examination because Muse provided a report to Northern Gateway. It was discredited there as well. So what we have is an example at the Trans Mountain hearing, because of the absence of cross-examination, a report provided by Kinder Morgan is given credibility that it doesn't deserve. As you say, one of the areas was that he assumed in his report that Keystone XL did not proceed, neither did Energy East. He assumed that in 20 years, with an incredible increase in the amount of supply of oil, that no new pipelines will be built. So what that does, what that assumption itself does, as you've identified, is completely bias the need for the pipeline in favor of proceeding with the project. So absolutely. Now, if we get Line 3, which is going to increase the capacity for export to the United States by more than 370,000 barrels a day. It's a 36-inch pipeline. It can actually deliver over 850,000 barrels a day. They've only applied for 760,000. And that would be an incremental 300,000 plus. That if that pipeline is built, and it's a replacement project, so it's very likely it will be built, there really is no need for Trans Mountain. And then if you build Keystone XL on top of that, you're having hundreds of thousands, if not over 1 million barrels a day of excess capacity. And excess capacity has a cost. And none of those costs have been considered either.
Wow. So, I mean, with the favorable, to put it politely, the favorable ruling on tolls, the steadfastness on sticking to the low project cost estimates, the cost of the Oceans Protection Program, the special fee on shippers in 2011, Isn't the National Energy Board guaranteed government support for this project long before where we are with a bailout?
That's a really good way to put it. Absolutely. This project has been supported by public decisions from the beginning that have allowed it to advance to a stage where it should never have gotten to if proper market analysis had been done. It's just, you see, we do know that the environmental threat of this project is huge. Not just if there's a spill, and there will be a spill. So I should say not just when there is a spill, and it will be, a major to catastrophic spill over the life of this project. Not just when that happens, but even absent a spill event, the environmental risk of this project is huge because of the amount of heavy oil that will be produced and burned, and because of the impact of the tanker traffic on the marine environment, particularly the killer whales, the orcas, and the fact that it entrenches us into a petroculture psychology more than we have right now, where instead of switching our attention to alternative ways and means, we are building into a dependency. The federal government, when it agreed to pay $4.5 billion for the existing pipeline system and the spend to date on the expansion, had the government said to Kinder Morgan, if you need to walk from this project, go ahead. So had Kinder Morgan walked from the Trans Mountain expansion with the contracts with shippers, Kinder Morgan would have only been on the hook for about $200 million of cost to date. The actual 13 shippers that signed on would have probably picked up about $700 million of the cost to date, and then $200 million or so would have been paid out of this special fee that was approved by the board way back in 2011. So what Ottawa did, though, is they came in and said, we'll pick it up. We will pay you for your spend to date, thereby taking the shippers off the hook for what they would have been liable for. And we will continue to proceed with this project and pay for whatever costs are incurred between now and completion or now and termination. And so we have a situation where taxpayers have paid a premium for an existing pipeline that's more than 65 years old and is going to suffer significant capital cost needs to just keep it running properly. Paid a premium for that, paid $900 million for spend to date. And if this project doesn't proceed because it's stopped through either the courts or public efforts through coast protection protests, then taxpayers are going to pay for whatever's spent between now and then. And so, under this guise of, well, we've got to create opportunity for new markets and expand delivery of product to market, what has Canada really bought? Right now, what it's bought is an existing pipeline serving existing markets that creates no new jobs. They just picked up operating assets and paid a premium for them. And they have the right to try to force this project into an economy and a society that doesn't want it. And there's a very great likelihood it will never be built. And we will end up picking up the tab for that when it should have been stopped with Kinder Morgan. It should have been either Kinder Morgan walked from the project or it didn't, and then it would have been on the hook for the cost.
Well, the other thing I wanted to mention to maybe try and explain why governments are so gung-ho to get this through, there's also $5 billion in exposure to Canadian chartered banks. There was an additional $550 million raised in quote-unquote preferred stock that's now held by the banks, but yet Kinder Morgan is still billions short of meeting their conditions to get this project constructed. It just seems to me when people understand the layout of this entire project, it seems to me that it's unavoidable that Kinder Morgan never tried to come up with the money on their own. They never tried to present a credible business case for this. They simply relied on their old Enron games and a capitulated National Energy Board to sell this to the public. Is that accurate?
Yeah, it is accurate. There's no question that they needed the National Energy Board complicity in this deception to get it to the point where Ottawa would consider it. And now we have complicity of the federal government and the Alberta government trying to pretend that the benefits are there, that the safety is there, that the impact isn't going to be negative. When you try to, right now, there are fewer than 30,000 barrels a day of heavy oil transported through BC. This idea that somehow heavy oil has been transported for years and it hasn't been a problem, well, there's hardly been any shift. Yeah. It's light oil and gasoline, diesel, petroleum products. So, for example, last year you have fewer than 30,000 barrels a day, and they want to increase it to 540,000 barrels a day. Well, that's more than a 20-fold increase of risk. And none of that, that's why BC's requirement, the question it has before the courts right now is, do we have the right to keep the transport of heavy oil where it is right now, to be and to keep it there while we make sure that it's safe to transport more, and if it's not safe, that we can restrict the growth of the transport. That's all BC is asking for, and that's prudent. That's a good question. When we're hardly shipping any now, we should know what impacts it might have if we increase the volume by 20-fold. Now, if we go back to what Kinder Morgan, the ransom note they gave on April 8th, and they said, if we can't get clarity that when we start construction, we'll be able to finish, then we're going to leave. Where they really were at that point, they did have a $5.5 billion construction facility with predominantly Canadian banks, but they didn't have about $2 billion in equity they needed. They had raised the $550 million in preferred shares, but they were still shy about $2 billion in equity. And the capital markets in Canada were basically saying, we're worried. You're probably not going to be able to get the money in the private sector in Canada. They certainly couldn't get it in the U.S. They had been trying for years to get it in the U.S. They had tried to get joint venture partners. They'd tried to figure out how they could raise the capital there, and U.S. markets weren't interested. They came to Canada and did the initial public offering for the Canadian assets in May of 2017, and the money they raised in that offering went to Texas to pay down debt of the parent. So we have an outflow of 1.7 billion Canadian from the Canadian economy through the initial public offering. It was only then that the bank said, okay, we're willing to lend you 550 billion, but you got to raise the extra equity. They go out, they raise 550 million in preferred shares, and then the market seems to be drying up. So they come to the federal government and say, if we can't get clarity because BC's in the way, we're gonna leave. And that gets me back to my point that had BC not been in the way, there's a real question of whether or not it's in the way. It's just trying to make sure the product's safe. That would be one take on it before they allow a 20-fold increase in its transport. But let's pretend that BC had not asked the question. Kinder Morgan would still have been in the position where it was looking at pulling out because it still needed to raise billions in equity and the markets weren't accommodating. So what happened then? Well, Ottawa comes in and says, we'll pay you $4.5 billion for the existing assets and what you've spent to date. And that's when Kinder Morgan canceled its credit facility with the banks. So the $5.5 billion, they were able to retire. And they went into a $500 million line of credit working capital facility for the assets they're keeping after the sale. What we do know is that the Royal Bank of Canada and TD Bank came forward and said, we will lend $1 billion to do construction throughout 2018. And that's where the EDC credit guarantee comes in. So the Canadian government says, okay, and we will guarantee that $1 billion in construction spending. So that's what the Canadian government's now on the hook for. It's on the hook for the $1 billion in construction spending facility as a guarantee. It's got to come up with the 4.5 through the Canadian Development Corporation, the Crown Corporation that's going to own the assets. It's got to come up with $1 billion in financial assurances for the Pipeline Safety Act for the land spills. And it's got to continue to spend on the $1.5 billion Ocean Protection Plan. And then there's Condition 121 that says when this pipeline is operating, the new one, you need another $1.1 billion in financial assurances to protect against land spill for that. So that's another $1.1 billion Canadian taxpayers are going to have to come up with.
So this is really the ultimate pass the buck. and Ottawa seems at this point more than willing to take it. Is that accurate?
Well, Ottawa is willing to take it because they have put so much of their political capital into this project. They, Prime Minister Trudeau has bet his political future on this pipeline, as has Rachel Notley. And the problem when you put political capital into a project like this without having done the due diligence on its business case, its economic impact, and its environmental impact, then you find yourself boxed into a corner where you're willing to basically waste taxpayer money to get a project built. And that's where that's the situation they are in right now, where they keep trying to market this thing as if it's financially viable when it's not, as if there's going to be purchasers available when they're not, as if the private market's interested in it when they're not. And we have a situation. I was surprised when Finance Minister Murnau said, pension funds are going to be interested. In fact, Canada Pension Plan should be interested in something like this. More than a year ago, Kinder Morgan went to Canada Pension Plan Investment Board and tried to sell the project to Canada Pension Plan Investment Board, and they passed. And now Murnau is trying to pretend this is a new opportunity. There is no investor looking at this from a prudent business approach that would consider this to be a good investment. So I think what we're going to see down the road is if Canada is capable of selling this project to other parties, they will do it at a discount. So they pay a premium and then they have to sell it at a discount. So we'll get dinged on the way, as taxpayers get dinged on the way in and get dinged on the way out. But not only with the business deal, but as you've mentioned, there are all these other ways from day one that we've been dinged. And whether it's the subsidization through the Special Firm 50 fund that has helped underwrite the cost to date, or whether it's a doubling of toll rates on the existing project that's going to cost the economy, or whether it's the subsidization through, the Ocean Protection Plan should have been paid for by the shippers, by the oil producers that are going to get the benefit from, they think, from shipping this oil to market. In fact, Kinder Morgan told the NEB that if there were conditions required to make marine transport safe, that the shippers would pick up the cost. Ottawa steps in and says, oh no, we'll pay with taxpayer money. There was no reason for Ocean Protection Plan to be paid for by the government. But the government probably knew that if that cost had been borne by the shippers, the toll rates of getting that oil to market would have made it uneconomic. So you see, again, market factors are being ignored to try to make a project that is not economically viable.
My God, what a mess. Well, the next thing I want to move to is, I'm surprised it took this long, but what's now seems to be making the rounds is talk about everyone's friend, NAFTA Chapter 11, Investor-State Dispute Settlements. Now, there's one line in particular from the NAFTA agreement that I think is very a threat to governments. Well, the federal government's the only one that gets left on the hook. NAFTA Article 1121 waives the local remedies rule. So investors are not required to exhaust local remedies before filing Chapter 11 claims. Do you think there was a threat by Kinder Morgan that we're not going to wait for all these processes in the Federal Court of Appeal and elsewhere? We're just going to slap a lawsuit on you guys. Do you think that was part of the backroom discussion?
I don't know, because I'm not privy to those discussions, but here's where I think, because I wondered about the NAFTA impact and if Kinder Morgan was getting set up to do that. But here's where that kind of an approach where they're weak. Where they are weak is they couldn't finance it. So it's hard to argue that, they were having extreme difficulty financing it. That Ottawa came in and said, we'll indemnify you against any risk going forward. And they still said no. So I think the better way for me to say it is that they were having extreme difficulty raising enough money to proceed with the project. And if they were having difficulty or could not raise the capital to do it, then it would be hard to bring forward a claim saying it was the government that was the problem. So I think that they were on a bit of weak footing there because the project's not commercially viable, and they knew it. And so that's where I think even if they had threatened NAFTA, it'd be a bit of a weak threat. Go ahead.
I was going to say, okay, so now let's look at what has changed. Now that the Canadian federal government has stepped in to, quote unquote, guarantee progress, does that actually strengthen a Chapter 11 claim now?
Well, my understanding would be, is that Kinder Morgan has agreed to sell the assets. Okay. So the claims are gone.
Okay, but I mean, that does sound like a suitable Enron solution. Let's just dump it for big profit and whatever. Well, their main responsibility is to their shareholders, and they've lived up to that responsibility. If our laws and our tax system is such that they can take this kind of advantage, if they can play the regulatory agencies because the regulatory agencies have been captured by the industry and want to facilitate projects, then, they're legitimately using the leverage they have. Where I think it's reprehensible is when parties say one thing and do the other. And there's no question Kinder Morgan has said one thing and does another. There's no question the NEB has said one thing and does the other. And there's no question that Justin Trudeau's government and Alberta's government do the same thing. So that's where I think from the point of view of the public interest, that the real tragedy exists, is that we have seen a system eroded that used to protect the public interest that no longer does so. And people are feeling very frustrated that our interests are not being protected. And I think, as much as anything else, what this project represents is a breakdown of the integrity of government and democracy. And that there's a bit of a line in the sand being drawn here, that if this project proceeds, what it represents is a very different world than the one many Canadians expect exists in our government, in our society. And, there's no question that we have been played by a U.S.-based company that is a master at this game. And the fact that the NEB didn't call them on it, and the fact that Ottawa isn't calling them on it, is perturbing. And I think that's where, we're being told the National Energy Board is going to be restructured and the board members are going to all lose their jobs because they're looking for new board members. But they approved a project that is now still proceeding. How is that legitimate? And then we have a situation where Ottawa has bought a project and the National Energy Board that they're going to dismantle is still responsible for making sure the conditions are fulfilled. And now we're faced with kind of scrutinizing their new owner that's also responsible for this dismantling. I mean, it's a bizarre situation. This thing is going to play out over the next few years. We've also been told that there's some idea that maybe there'll be a consortium of First Nations that are going to come forward to try to help the investment strategy move forward. And when I look at that and say, well, you've got a situation where there are many First Nations that are against this project. And now you've got a government actively trying to promote First Nation investment in the project. And the specter of having First Nation pitted against First Nation, where there's some parties that have invested that want to see it proceed that are First Nations and some that don't, is a very dissettling scenario, that you have Ottawa actively engaging in generating a conflict among First Nations. That specter exists, and it's very unsettling. Yes, I have heard a lot of that already from some people such as Russ Diabo and others, that this seems like a new tool in the colonial toolbox if they try and go down this road. It's not helping, let's put it that way. The one other thing I wanted to cover with you are the two words that we're going to be hearing more and more about as time goes on, and that's stranded asset. It was only a couple years ago that the SEC in the U.S. forced ExxonMobil to write off billions of dollars of reserves in the Athabasca oil sands because they based their criteria on recoverable assets with present technology. And the Security and Exchange Commission said, you know what? You can't do this. It doesn't meet the criteria. Write it off. Do you think that there's a possibility in the future that this pipeline itself, if it's built, could be a stranded asset?
Yeah, I do think it could be a stranded asset, and I think one of the things we're seeing already is that oil sands are already stranded assets. It just hasn't filtered through yet, and part of the reason is that this is a low quality oil that has very high sulfur content. And we know that the International Maritime Organization is bringing in low sulfur rules in January 1st, 2020, which will fundamentally alter the demand for heavy oil in the world, which will then fundamentally reduce its price. And so you've got a situation where the demand worldwide is falling. There's an increasing supply of light oil. There are alternative technologies that are being introduced. There are all sorts of factors that are leading to a major decline in the demand for this oil that will fundamentally reduce its price and therefore reduce its return on investment. And that means that barrels are going to be stranded. So in addition to the other factors, yes, absolutely. We have a situation where this pipeline, if it does get built, will be underutilized, particularly, as I said, if Line 3 goes forward. And so what you will end up Ottawa having invested in a white elephant.
You know, it just seems to me that if you're looking from what you would assume government's job is to protect the national interest, there's those two words again, to protect the health of the national economy, to protect taxpayers themselves from unneeded risk, then this is just the wrong direction. Completely, is it not? Why would they not take the opportunity at this point in time to say it's time to pivot from this sunset industry, especially with an inferior product that we have way too much of, that some people are determined to make a buck off? These billions of dollars they're willing to give to support this project, why is that money not being spent on energy diversification?
Well, yeah, I mean, you have to ask them because it doesn't make any sense to me what they've done. But as I said, from day one, this project did not make economic sense or financial sense. But it was forced through a system that has eroded, and we find ourselves, at the place we are today. Had the checks and balances been in place, we wouldn't have this huge, obvious mistake being made. And it really goes back to systemic risk. I mean, when they talk about events like the Kalamazoo spill. The spill in Marshall, Michigan, of heavy oil into the Kalamazoo River that was a catastrophic event, or what happened in the Gulf with the explosion there, Exxon Valdez, or we talk about any major catastrophic events, you can always trace them back to a string of small mistakes that lead to a huge event. And it's called systemic risk. It means the system fails you. And what we have with Trans Mountain's purchased by the federal government is an evidence of systemic failure. And we are now in a position where it should never have gotten this far.
So is it merely political means that are being protected here? Is this entire project still going forward because of political calculations, in your view?
Well, yeah. I mean, the reason that Ottawa purchased it was because they got themselves into a political box. So, that they're leveraging their access to monies to try to solve their problems.
Robyn Allan, I would like to thank you for all the work you have done and for trying to keep the Canadian public informed about the truths about the Trans Mountain project, which is in direct conflict from the NEB and governments across the land. We all look forward to further efforts from you to expose this and who knows what's coming down the road. I thank you for your input. I thank you for your expert opinion. And I thank you for being on The View Up Here.
Thanks very much, Glenn.
All righty, there you go. Robyn Allan. Personally, I thought that was a great interview. That was a lot of fun. But, maybe I'm biased. There's some truth on Kinder Morgan, Trans Mountain, National Energy Board. How did this happen? Next week on The View Up Here, a discussion about how chronically underfunded Canada's social welfare system is. There's been some studies out lately from OECD, some other ones closer to home. Greg Fingus will return to The View Up Here to discuss this and other related topics. Where is the money going? At Jurist Blog on Twitter. Greg Fingus, back again next week. As for now, once more, I say thank you very much, Robyn Allan. Until next time, she appears. And until next time to listeners, that's it for tonight. Thank you for listening to The View Up Here. Good night.